Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome to Nirmal Bang, ladies and gentlemen. I'm Hiral Dadia. We have with us Manish Singh, CFA CIO at Crossbridge Capital, joining in. Manish, good afternoon and welcome to the show, and
Good
always a
afternoon.
pleasure to speak to you.
Good afternoon.
Manish, my first question coming to you right now is with regards to where the US markets are concerned. Overall, if you go to see with regards to where US goes, we did rebound, to end the week close to record. And this was mainly on the back of the earnings that have come out, as well as the economic data that has come out so far. And from here on, all eyes are going to be with regards to what the Fed meetings tell us. You have the US GDP, which is coming to a forecast to show a robust 6% growth in the first quarter. Clearly, if you go to see from here on, do you think this is a trend which is expected to continue?
So good afternoon once again. My view is that you're going to see robust GDP growth. So there are two sides to the story. The COVID story will continue. I mean, it is just playing out as you have seen, and probably with a different time lag in different countries, but that will play out. But if you look at the fundamental underlyings of the economy, and especially given the amount of liquidity that is pushed into the economy, and the amount of fiscal support that has been provided, that you're going to see really a very high GDP growth. I mean, today in UK also, Ernst and Young, they updated the GDP growth from 5% to 6.8%.
Hmm.
In US, you are definitely going to see 6% per annum or over GDP growth from the likes of it. Now, this will come as a surprise to many people because you have to go back to at least 1980s to see such GDP growth in the US.
Hmm.
And a lot of that is really coming from the monetary and fiscal accommodation that is put in place and that continues to be in place as things are recovering. So there will be surprises on the side of the asset side where people will be shocked and surprised that, oh, how come the GDP is growing, consumption is growing, and things are growing. But there's a fundamental reason that you have provided capital, and you're providing capital to even businesses that should not get capital, because that's what happens when you have too much of liquidity. Because think about that, if there are lots of people who have great ideas but don't put into practice because they don't get the capital easily enough or at an easy rate.
Hmm.
When you make that happen, then even those businesses come into fruition, and that just means more economic activity. So I just see that there is going to be higher productivity and higher growth rate driven by liquidity for right or wrong reasons, but a lot of good business have managed to get money which otherwise they wouldn't have. And then of course you have pent up demand and money being given to people to go and spend. So you're going to have that phase come through in Q3 and Q4, and that will push the asset prices higher.
Right. So, with this, what's your expectation? What are you expecting the FOMC to come out and stay? Do you think that they will not really talk about officially raising rates or otherwise signaling any backing away from the easy money policies that have been rolled out to aid the US bounce back? Because there are still fears of rising inflation. So, what is the kind of stance you're expecting from the Fed?
Yeah, so I think Fed was very, very clever in the last meeting where they said is that they are not going to react to expectation. They will react to actual data. So that I think is very effective way of saying is that, well, that's to put the cat among the pigeons, that you keep having stats every time, let people react, inflation up, inflation down, inflation up, inflation down. They're going to do nothing about it unless they see that inflation numbers show up in the PCE numbers and other things that they look at. That'll take time to show up for various reasons. Because if you see what the PCE or the CPI in US measure, it actually does not measure the inflation that is in the economy. If you really want to see inflation, you go and check your credit card bill, check your student tuition bill and all. It's there, but just that it is not captured in the data. So that gives Fed even more leeway in when they are going to act, which means that it will be more accommodative, more stimulus money will be pushed in, and then they will be not forced to act because that has not shown up in the data. And this is what I keep saying, why I'm saying that record GDP growth is going to happen, because this thing is going to flow through, and Fed is in no hurry to stop that because they say, look, it is not in the data. And now inflation has been there in the economy, but not in the data for a long time. So this is where I think this is going to push things, and Fed is not going to be pushed around to act prematurely, and that just means that you will have more nominal GDP growth. Inflation, I think, just a couple of things on inflation, or maybe you want to touch inflation next question. But what I would say is that, if you look at inflation, the inflation has to come through wages. That's where the inflation has to come through. Because unless and until the wages increase, you're not going to say inflationary pressure. But even for that to increase, it's what you have to measure is not the level of unemployment rate. It's the level of movement that is happening. It's not if people are employed, but if they're not changing jobs, then there is no wage pressure. And that's what has happened in US and Europe in a long way, that people have not been moving jobs. Now that's partly because there are big monopolies, big business have done very well. So there's less competition. So you don't move to a new jobs. And unless you move or the business feels that they are going to lose people, they don't raise wages. So one of the permanent things that has happened in US because of technology is that the wages have not risen. So if you really want to see inflation, you have to see that in the wages. If the wages are rising, that's when you really worry about inflation.
Correct. So with this, what is the kind of inflation that you're looking at from your own? Do you think that taking growth into consideration, even the Fed will be ready to compromise on the inflation target so far?
Yes, I think they will let things carry on until at least 2.5, 3%. If it continues to set at 3% for a few months in a row, then they will get concerned. Because think about that, the year-on-year number doesn't make much sense even in GDP. You could have an 8% GDP print, but that's because last March was horrible, or April was horrible, or the last quarter was horrible. So I don't think that they will really get worried about year-on-year numbers being higher, because they really want to see that it sets and it continues to be on that trend for at least 2 to 3 months. So I would say that even if you see 2.5%, 3% GDP print, it will not make Fed worry, because if this is transitory, as they keep saying, and we don't know, because honestly we do not know how this is going to evolve, no matter how much we forecast and predict. The technology will continue playing a disinflationary pressure as it has. And that is just not going to go away. The technology and digitalization of the world will continue. And that will constantly put the disinflationary pressure. And the wages or the money supply is going to put inflationary pressure. And let's see how does that lead to. My personal view is that you will see a bout of inflation, but that will be temporary. Now, the temporary, I cannot say it will be 2 months, 3 months, 6 months, or 12 months, but that's my central view, that you will see inflationary pressure as things open up, because there's lots of money to be spent, and those things are going to drive things pricing up. But for really the inflation to be sticky, you have to see the wages increase, because that's when it becomes sticky, and then Fed will have to get concerned. And Fed is not that concerned, at least for this year. We'll see what happens, going next year, because you will see a good robust GDP print, maybe 2.5% inflation numbers in US, 275, 3. But if that continues into next year and the wages rise, then Fed will have to act, and which means that they will raise rates then.
Right. So with that, how do you see the Treasury market moving? Because clearly Friday's session, you did see US Treasury yields that moved higher. Today as well, there is a marginal uptick coming in. Now, it's mainly the positive economic data that's giving support to the equity market, that is weighing on the demand, for the haven assets and pushing Treasury yields slightly higher right now. So taking the current scenario into consideration, anticipating what the Fed could do from here on, how are you expecting Treasury yields to move?
So Treasury yields for this year, as you know, has come back up from like zero point 0.9 to 1.7, we saw. So that's already almost 80% increase that we have seen. I do not think that Treasury yields will continue to rise a lot, by which I mean that, yes, you will get to maybe 180, maybe 190, in later part of this year. But then also think about what else is happening, that there is a lid being placed when Biden administration talks about they're going to raise capital gains tax, they're going to raise some other taxes. Then suddenly this whole thing about runaway asset prices and runaway price level is just not there, because there's doubt in everyone's mind, even corporates mind, everyone's mind, that how things are going to evolve. So while people may not like that, what they're talking about taxes, but that does put a lid on runaway prices or runaway asset price increase. Now, are they going to increase are they going to increase tax rate? Absolutely, because the Biden team has said that all through the campaign, and market knows that. Now, whether that capital gains tax is going to be raised from 20 to 30 or 40, that we don't know. I personally think that if it raised to 29 and 30, market will be fine. You're not going to see massive sell-off because everyone expects rates are going to rise. And also people who are ultra wealthy, I mean, who billionaires, they have organized their affairs a long time ago. They don't wait for announcement. They have trust, they have legal advice, law advisors, they do. So I think it's only the upper middle class or the stockholder they'll get impacted. But I think they can take that 30% tax right, 30% capital gains tax. The 40%, I don't know. Maybe some people will react. But let's not forget, they can make all these tax rates backdated to January the 1st. So it doesn't give you any incentive to selling it now because you're already going to get taxed. It's not like it is going to get effective 30th of September. So you sell your assets before that. If they backdate to 1st of Jan, then there you go. You are in that tax regime whether you like it or not. So I think there's a lot of nuance of how these things are going to evolve. In my opinion, treasury yields will continue to increase, but not as rapidly. Everything that is talked about in terms of tax is going to bring the yield down, and you'll keep moving in the range of 150 to 180. But I don't see it really going too high up, at least this year. Next year is a different story.
Right. And do you think that the tax increase by the US president is something which could have an impact on the US rally that we've seen so far?
If it goes to, as I was saying, that if they backdate this to 1st of Jan, then, well, nobody's going to escape that, right, in terms of capital gains tax. But if they leave it to 30th of September or something down, then there might be some selling off. But I always ask, sell off and then do what? That's the question, right? Sell off and then do what? Yes, you're going to pay a low capital gains tax, but then you're going to go back in the same equities, same stocks, the stocks that you like. So if you can tide over that 1 month wall, then the asset price likely are going to go higher because you're going to buy the same growth stocks or same good stocks because you're going to see 6% GDP growth or 5.5 or 6.5 wherever it is going to set in Q2 and Q3. So I do not see this long-lasting impact on that because once this is gone through, it's priced in. As you know, the market does not like uncertainty. I think that psychologically it's already priced in that the tax rates are going to be at 30%. If it was to set at 35, probably they'll price in the next 2 months, but that's about it. So if you take a 6 months, 1 year view, it doesn't change. If you take a 3 month view, maybe you will have some vol.
Right. And with this, Manish, how do you see the US-China issue and differences right now? Because they have continued so far. There was an anticipation as well that Biden administration would view its development objectively and rationally and explore with China a new path of, say, coexistence or probably a win-win cooperation. But that does not seem to have happened. How do you see this impacting the markets overall?
So I would say I have written on this since last 2 years, and my personal view is that eventually, US and China will trade and trade very well because they see each other as a partner. There's no equal to them in how things are going to work. US has major advantages in technology wise, China has massive advantages in production wise, and they're getting into technology side of things. So eventually, they have to operate with each other. Now, US also realizes that the balance has shifted and it has tilted, and we got evidence of that because if you saw the Alaska conference, which happened a month ago in Anchorage, the foreign secretary or the state secretary Blinken started by attacking China on Uyghur problem, and the Chinese politician. So it was a 2 minute opening statement. Blinken gave a 2 minute opening statement, but the Chinese side gave an 18 minute lambasting of the U.S. authorities on U.S. soil, which has never happened. So a lot of things are happening, where they know that the balance has shifted. China has major strategic advantages that they're going to play. So US is under no illusion that they can be very difficult with China to the extent that they're going to harm their own interests. So they will work with each other. China is under no illusion that US still has strength. So my personal view is that they will, as like anything, they two big companies, they compete like Procter and Gamble and Unilever, but they do understand what their unique advantages are, and they have to coexist. So they will find a way. I don't see any scenario of war or anything else. Least of all, I expect US to fight anyone else's war. I don't think they will, even if they continue to promise. And there's plenty happening production GDP wise where the GDP gap is closing between China and the US, and China has massive advantages that is built up. It continues to build up. And look at what they're doing with restructuring of all the big institutions in China. This is something the West should learn from. China does not want the too big to fail problem that plagues the Western world. So they're going after big institutions saying, well, we do not want the problem that the Western world is happening. So there's lots happening in China, which is very encouraging. The risk obviously is that it is run by Chinese Communist Party. So your wealth is never your wealth. It is the central government's wealth. So I think that risk will always remain. But from point of view of GDP growth and them finding as China is not looking for a war, US can't afford a war. And I think they will have to coexist and work with each other.
Right. And then with this, that's an interesting take that you've given us with regards to US China. Now, if you have to go back to the dollar as well, clearly, in the month of January, I think, Manish, everyone was talking about that, yes, there will be weakness that will come in with regards to where the US dollar goes. However, now if you go to see, there are these bouts of recovery that have come in. The dollar has started the week on a defensive below that 91 mark. It's the 10-year which has grabbed some traction so far. How do you see the dollar index also moving from here on, taking the surroundings into consideration?
Okay, so dollar weakness always with the question is with respect to which currency, because dollar obviously can be, stronger or at par with emerging market, much stronger with emerging market, but much weaker with the European currency like sterling or euro. If you see dollar with respect to sterling, dollar has been weaker, and understandably, because UK has done a good job with the COVID vaccine and is reopening up. In Eurozone, while they haven't done a very good job, but they continue to support the economy with massive amount of money printing. So euro dollar is holding up at 120. Eurozone still has a trade surplus, and that's because they're not importing much, because the domestically they're not doing very well. Sometimes you could run a trade surplus, but precisely for the wrong reason, that you continue to export but you don't import because your local economy is not doing very well. And then when you have a current account surplus, then obviously you have a stronger currency because the demand for your currency is high to pay for all the imports that everyone else is doing. With respect to emerging market, yes, I think dollar will continue to be strong for now at least, because of various questions that are being raised about what's happening in India with respect to COVID, as you have seen recently. But in my opinion, these are just short-term things. If you look beyond 3 months, and let's hope that in 3 months, India has complete control over its own COVID crisis, then you're back to the dollar weakening story, because the whole reason why you have been buying dollar assets or US Treasury, those things are going to go away because you are in a global growth story. When you go in a global growth story, then again, dollar weakens because you are selling dollar to buy assets abroad, investing abroad. You have a global growth story that will come into play. But that has not happened. So the dollar weakness was talked about at the start of the year, end of last year, was the right thing to do. But we are still in this COVID crisis, which we haven't gotten out of. And therefore, the demand for dollar and dollar asset has remained strong.
Right. So when you talk of this, how do you see, where would you place India overall on the emerging market map, taking, the kind of data, the way the markets are reacting in the US as well as in terms of where Europe goes? Where would you place India as an emerging market now?
No, I would say that, India, I mean, sadly, India is always an attractive market, that is what everyone says because of various structures that we have. In my opinion, government has done a reasonable job over last many years. Now we are in second term of Modi government, but they have plenty to do in the sense, there is plenty of things that they could have done which they haven't done. But if you look in terms of the communication, and I think that establishing a perception is so important when you're running a nation, how your economy is perceived. This whole thing about national branding at a stage where people trust you, where people trust that you're going to make changes and the right changes, is so important because that sets the momentum. That has been lacking, and I don't say it's because the government is not willing, or Prime Minister Modi has done a bad job, but just that we do not have those structures in place which really puts India like, okay, we are reforming, and that story has to go out to everyone. And then of course we have a COVID crisis, so that puts you back again, and then you have reliance on the oil bill and other things. So I would say that, emerging market, India as an emerging market story continues to be attractive purely for growth reasons, right? Growth reasons. If you're growing at 8% 10% or
Mhm.
11%, as the case may be, because you're coming from a low growth last year, then people will look at that. Because when you are a corporate, you're looking to sell your products. You're looking to sell your products in the market
Yeah.
where it is going to grow. But I would say that India's growth has to come for domestic reasons. If you look at what China has done, China never went out and said everyone they are there to just conquer the world. We want to partner with X, Y, Z. And this is something I just do not like about India. India is so much about going into US camp, and I hope India learns a lesson from this COVID crisis, where the Biden administration has not released raw material, and that teaches a lot of politicians a lesson in diplomacy, that you really have to make yourself stronger. You really have to make yourself economically stronger for anyone else to see you as a strong partner, and therefore to do business with you. And I think that that is something India has to do locally. India has the expertise. It's a matter of changing the rules. It's a matter of government focusing that it is our internal strength. And they have done a good job, because if you think the amount of roads and infrastructure play that has been happening in India is tremendous. But given where we are starting from, a lot more has to happen, because there is still frustration in businesses when they do business that they are not doing it very well. There are still big houses in India that dominate these things, and those needs shouldn't happen, because everyone else should have a chance for you to have a great growth story. But something tells me when you have a crisis like this, the big businesses will again dominate. And there has to be an active way of encouraging smaller businesses also to play an important part. But India is always like, it's like it's a big promising story. But every time the promise rises, something happens, and then you pull back, and then you wait for things to improve, and then you pull back. But hopefully, we are getting somewhere, and after this COVID crisis, it'll restart once again. But it is an attractive market, I would say, on a medium to long term, and that hasn't changed because of COVID or anything else.
Right. So with that, we've spoken about India as a double-digit growth. I mean, RBI is expecting a 10 to 11% kind of a growth in terms of FY22 as well. Do you think that's something which could be at risk, taking the second wave of COVID into consideration, and all of these forecasts would actually not hold true?
Possible, because if you look at fundamentally what's happening, I was reading about, so India was just about to reopen after the first or second lockdown, and people were coming back to work, and migrant worker and everything, and now everyone have been asked to go back, or they have moved back once again, and to mobilize these things again will take time, and that affects your consumption numbers. So clearly, the in terms of data, I'm very sure that we'll have a disappointing data. But if you look at why this disappointment has happened, it has happened in a pandemic, then one has to be constructive that this can be built back very quickly. Because if you decide to shut down, I don't see that as a negative, because it's something that you have decided to do, not because something happened which is structurally going to depress your GDP. That's not the case. This is not a structural problem that we are looking at. It's based on an event. So yes, that leads to a delay in opening, but that means that when it opens up, you're going to again have those numbers come through. So COVID has not been a structural story. If anything, it is actually structurally positive, because it leads to more use of technology, more use of increase in productivity, more consumption, better healthcare, better everything. So I just see it from a structural positive number. If India starts spending more money on primary healthcare, which as it should, and it should improve those things, I mean, that is how you grow your GDP, because that is just part of the whole production scheme. So if this is seen as a positive, the impact medium term actually will mean higher GDP, not lower GDP. I mean, in the short term, yes. So I would look beyond that data. I would look at what structural changes India is putting in place, which makes it attractive and a better market. So I would rather be positive and not look at any short term or one quarter negative GDP growth and worry about it being a problem. Now, of course, because we have a currency situation, given our import bill, one has to be careful that how much of foreign currency we need. And now that is something that one could get into in a short-term risk scenario, but I don't see that as a big crisis happening, because there's plenty of goodwill that India has in the market from what it has done. So I don't see this as a scenario where a short-term run may happen on something, because you have a majority government that can change rules very, very quickly. And let's not forget that the majority government is one of the strongest factor that you need in a country, but that's when you can change rule very quickly. India could start selling stake in government-owned entity, and India could raise a lot of money. If you start privatizing even 10% of some of the big institutions, you have billions of dollars that you could raise very quickly. So India has options that it can choose to take, and probably it will be a good option because you get government out of running these businesses, get private people in, get private capital inside, and I think well that's something India should do. I don't know when India is going to do, but you have to sell stakes in big businesses, get private capital in, get better management in, better monitoring everything, and that will just make you even more attractive to global market because more people are going to follow the stock, follow the company, write about it. It's just a structurally positive thing to do.
Absolutely, and that's something that needs to be factored in. So, Manish, very lastly, taking India's growth story into consideration, how we function from here on, broadly, what are the sectors that you would say that could be growth drivers from here on, and which are the sectors, according to you, that could be laggards?
So see, I would say that for emerging market like India, you always have to look in terms of cyclical sectors, industrial or consumer, where really the growth is not just coming from from a structural, from a cyclical reason, but there's also a growth which is structural. Population growth, consumption growth, savings growth, everything that is going to do. So banks are going to do well, autos are going to do well, consumers are going to do well because that's where most of the things are going to lie from. Now, I would look at healthcare as well. I just hope that this COVID crisis has encouraged people to think about that how the primary healthcare sector is established and how what this means, because there is a huge demand for these healthcare and assets that are going to put in place, whether it be from the government side or the private side. How much of that can be serviced internally, we do not know. How much but that's one more sector I would look at, that how much of these things will be done internally. There will be a genuine demand from the consumption side or consumer side. There will be a genuine increase in thinking about how we are looking after our healthcare, how we are looking after our people. India has made a good start in terms of insurance, as providing insurance to government-owned insurance. I mean, that sector has to grow. That has to grow, and that will lead to more growth in healthcare. So I would look at that. But apart from that, I think the banks, autos, consumers, that will be the sector which is going to grow in line with the cycles.
Absolutely. And I think it seems that the growth story will remain intact till the time things go hand in hand. Thank you so much, Manish, for joining us on the show. Always a pleasure to have you and get a holistic approach of how we should be seeing the world as well as the domestic economy as well. Stay safe and thank you so much.
Thank you very much. Thank you for having me. Have a good